Growth, value, dividend. These are the three types of stocks you can buy on the market. Welcome back to the channel, guys. It's me, Adam. You are watching Steady Invest. Thank you everyone who have watched my videos so far, who have been commenting, leaving those likes, subscribing. You guys are awesome. You guys are the greatest, the reason why I'm doing this. I love it. I enjoy it. So, without further ado, number one, we have growth stocks. And as the name implies, they have tremendous potential for growth for the foreseeable future. What these companies tend to do is they take all of their profit and reinvest in themselves so that they can get bigger and bigger. Investing in growth can be high risk, but also highly rewarding because a lot of these companies are newer. When you invest in a growth company early on, you can see tremendous wealth being generated. The opposite can also be true because a company may go bankrupt by the time they can figure it out. Think Apple, Amazon, Microsoft. Imagine you invested in them before they were big, you'd be rich right now, and you're probably not watching this video if that's the case. If you are, welcome to the channel. Now on the other side of that, think Blockbuster. Back in the early 2000s, that was the future. VHS tapes, we had our VCRs, and what happened? Technology advanced, we got away from that stuff, and Blockbuster pretty much went under. In addition to these inherent risks, growth stocks tend to be very volatile in the short term as well. So make sure you do your due diligence, research the fundamentals, and be in it for the long term when it comes to growth stocks. Another thing you have to consider, especially with tech growth stocks right now, is that you have to pay a premium for them. This is due to higher expectations from investors for higher sales and profits in the future. Expect higher price to sales ratios as well as higher price to earnings ratios. The price is expensive now, however, investors are expecting big things. Number two, we have value stocks, the Warren Buffett way to invest. Value investors are looking for stocks that are trading below their intrinsic value, which is a fancy word of saying undervalued. Undervalued companies can provide long-term profits for those that do their homework. They may have high dividend payout ratios, low price to sales ratios, low price to earnings ratios, and if you find these deals before Wall Street does, you could be swimming in money. However, it goes without saying there's also a downside to value investing. There's something called value traps, and that's when a stock is priced cheaply and for good reason. Perhaps something fundamentally has changed with the company, and that's why it's trading so much lower than it originally was. Let's look at an example of office buildings, airlines, banks, restaurants. Ever since the virus happened, these companies are no longer the same ones they were before the virus. They have fundamentally changed. They will never be the same again, but that doesn't mean they won't come back to life. But let's say we have another lockdown coming and the government doesn't bail these companies out. They can go under, they can go bankrupt. And last but not least, number three, we have dividend investing. As the name implies, you're investing in a company with their dividend in mind so that you can receive a regular income, and these companies pay you a part of their profit in the form of a dividend. Now, there's a lot that goes into dividend investing other than just the dividend. There's the fundamentals, obviously, dividend growth, dividend stability, so on and so forth. Another huge benefit is that other than the dividend, you're also getting share price appreciation over time. Or if we're going through a recession or tough times, or the share price has gone down, you'll still be receiving those dividends either way. What are the risks? A company can slash or cut their dividend at any time. And again, I'm sorry I keep saying this, make sure you do your research that even if there is a recession or tough times, that company can still pay out their dividend. Another downside of dividend investing is that the share price doesn't always go up as fast as, for instance, growth stock. However, the trade-off for that is stability. Now, no matter what kind of investor you are, whether it's growth, dividend, value, all three, two of the three, whatever, there are just so many factors that go into investing. There's just so many different variables, so many different things you have to look at that you really have to make sure when you're picking your stocks that you're picking the right ones for you. Otherwise, it may be better to invest in ETFs or another kind of investment vehicle. Otherwise, I hope you found the video useful. Thank you for watching. If you haven't already, subscribe, like, and comment. If you want to join Wealthsimple or Questrade, use my links below. We'll both get money for it. Otherwise, see you guys in the next video.